Welcome to Breaking News to Trading Moves. Today we are opening up the playbook on one of the more talked about private equity transactions we've seen recently in the enterprise software space, the acquisition of OneStream by the firm HG.
And for you, the listener, we're really going to cut through the noise today. We have all the details of the deal, but our real goal is to detail exactly how this transaction creates, well, tailwinds for some and headwinds for others. It's about mapping out the consequences when this kind of capital gets deployed.
Absolutely. This is more than just a headline about two companies. It's a market signal. So let's just establish the foundation. We're talking about the private equity firm HG. They've agreed to acquire OneStream, and it's an all-cash transaction.
Straight cash. No complex financing. That speed and certainty are important. And as for the numbers, the deal puts OneStream's valuation at approximately $6.4 billion.
Okay, $6.4 billion. And what does that mean for the shareholders? What's the immediate payout?
They're set to receive $24 per share.
$24. Now, that's the number that gets the headlines, right? Because it's a 31% premium to the closing price right before the announcement was made public. That's a substantial premium for a company in this sector.
It is. 31% is definitely above average for this kind of take-private deal. But you have to look at the quality of the asset they're buying. This valuation really confirms that firms are willing to pay top dollar for these market-leading platforms, especially ones that have moved to the cloud and integrated newer tech like AI.
So they're paying for the future roadmap.
Exactly. They are paying for future growth that's already locked into that product plan.
And speaking of the roadmap, what's the timeline we're looking at here?
The deal is expected to close in the first half of 2026.
Okay, so a little ways out.
Right. But what adds a bit of stability and confidence is that the existing investors are staying involved. General Atlantic and Tidemark, they're expected to stay on as minority investors. Plus, you had JP Morgan advising OneStream on the deal, helping shepherd it to this outcome.
So let's talk about why this transaction is a focal point for the broader market. Beyond the big price tag, what's the core message being sent?
The core message is, well, it's a massive vote of confidence in the future of the CFO's office. We talk about digital transformation all the time, but this specifically targets the enterprise performance management space, the EPM space. It confirms that this type of software is seen as a high-growth, high-value asset.
And one that's maybe a bit impervious to broader economic slowdowns.
Relatively speaking, yes. Every company needs better financial forecasting and reporting, good times or bad.
So what does that confidence mean for their competitors, for their rivals?
It creates a new valuation floor. For similar enterprise software companies, this acquisition becomes a new barometer. It establishes a higher perceived price for an exit. We call it re-rating the takeout value.
So if OneStream can command a $6.4 billion valuation,
then its peers in this space suddenly look more attractive to other private equity firms or, strategic buyers. Their estimated private market worth just got a lift.
And OneStream itself was clearly positioning for this. I mean, they weren't just selling some legacy software. They've been focusing pretty heavily on artificial intelligence and much deeper integration with Microsoft's products.
That alignment is absolutely critical. It underpins a whole valuation thesis. This deal really emphasizes the value placed on platforms that combine AI think, predictive forecasting, rapid scenario modeling with seamless cloud integration. The buyer, HG, is paying for a future where this isn't just a reporting tool. It's an intelligence engine for the CFO.
Okay, so if that's the story behind the valuation, where does the capital flow next? Who gets a lift from this? Who are the beneficiaries? We can probably break them down into three distinct groups.
Let's start with the first category, the adjacent finance and reporting software peers. Just the existence of a large cash premium, delivered quickly, elevates M&A expectations across the board for them. It validates their whole business model.
Right, so the companies feeling this tailwind right away are OneStream's direct competitors in comparable firms. You're looking at OneStream, that's ticker OS, Workiva, ticker WK, and Blackline, ticker BL. It suggests the public market might be undervaluing these kinds of strategic assets.
Precisely. Now, the second category involves the private equity sector itself, the whole deal ecosystem. A high-profile transaction like this, especially in a resilient tech sector, it supports the idea that sponsors are getting more active again. It's all about capital deployment confidence.
And that positive sentiment flows to the big listed private equity firms themselves. So supportive for Blackstone, ticker BX, KKR, ticker KKR, and Apollo APO. How does it help them beyond just general market excitement?
Well, it helps through validation and fee generation. When a deal like this goes through, it confirms the sector is hot, which helps them raise their next funds. Plus, these firms often play advisory or financing roles in big transactions, so they generate fees, and the overall deal volume helps their bottom line. It just signals that there are good investment opportunities out there.
Okay, that makes sense. And our final category of beneficiaries. This one stems directly from OneStream's technology choices, right? Their tight integration with Microsoft.
Yes, given that strategic alignment with Microsoft 365 and Azure, any expansion and product investment from HG translates into more cloud and AI consumption.
It's the classic platform effect.
It's a textbook example. If HG funds a big R&D push for OneStream, and OneStream is built for Azure, their customers are just going to deepen their reliance on the Microsoft's ecosystem. This immediately benefits Microsoft, ticker MSFT, through Azure revenue. And don't forget the AI component.
Right.
That increased demand for sophisticated AI processing means more chips are needed, which brings in NVIDIA, ticker NVADA, as the hardware provider for those cloud services.
So we have a pretty clear picture of the winners benefiting from the price and the platform strategy. Let's look at the other side of the coin now. Which established players might be feeling a bit more pressure now that OneStream is armed with HG's resources?
Right now we're in headwind territory. The primary group facing immediate pressure would be Category 1, the existing Enterprise Performance Management, or EPM, and CFO suite competitors. HG's backing isn't just capital. It means OneStream can accelerate product development and ramp up its go-to-market strategy.
And that raises the competitive bar for everyone else. So this pressure falls most heavily on the companies that compete for that same CFO budget. We're looking at Oracle, ticker ORCL, Workday, ticker WDAY, and SAP, ticker SAP. Why them specifically?
Because they've all approached EPM from different angles. Oracle and SAP come from a legacy of ERP, Enterprise Resource Planning. They offer EPM as a module in a massive system. Workday bundles its financial management with its human capital suite. OneStream offers a very specialized, unified platform. Often that means better performance and faster deployment. Now with HG's capital, OneStream can close the gap on scale and distribution.
Forcing those giants to spend more to keep up?
To avoid customer attrition, yes.
Okay, so that leads us to Category 2, the best-of-breed finance tooling providers. The idea here is that a stronger OneStream platform encourages businesses to consolidate their spending into fewer vendors.
Exactly. The consolidation argument is what hurts the specialized tool providers. CFOs love the idea of getting rid of multiple vendor contracts and messy integrations. If one platform can handle finance, forecasting, and reporting, then dedicated tools for each of those start to look like a risk. This creates pressure on providers like Intuit, ticker INTU, and Bill Holdings, ticker BILL.
Their challenge is just to maintain their market share against a more integrated, well-funded alternative.
That's what's their challenge.
And for the final competitive area, we're back to the cloud strategy, Category 3, the non-Microsoft cloud ecosystems. We called out MSFT as a winner, so it follows that their competitors feel the pressure.
That's right. And this isn't just about a marginal loss of revenue for them, it's a strategic challenge. OneStream's Azure native position is a powerful incentive for large enterprise customers. When a company deploys a mission-critical workload like EPM, they often prefer to standardize on one cloud provider for simplicity, security, cost. So if OneStream is their choice and it's optimized for Azure, that drives more financial workloads onto Azure.
And that standardization is the real threat. If EPM moves to Azure, other services could follow. So which cloud providers are most exposed?
This could marginally reduce the share of wallet, the total cloud spend for the other platforms in this vertical. We're looking at Amazon, ticker AMZN, and Google, ticker GOOGL, as they compete for those same enterprise financial workloads. It puts pressure on them to either partner more aggressively or maybe acquire competing EPM solutions to stop Azure from gaining that foothold.
So it seems like whether you're a competitor, another PE firm, or a cloud provider, the message is clear. This unified, cloud-native CFO technology is highly valued, and the new owner is ready to spend to win that segment.
That's the main theme. This deal sets new valuation benchmarks and at the same time forces major players like Oracle and Workday to reassess their own plans.
Here is a final thought for you to consider. This newly aggressive OneStream is now directly targeting a market that companies like Oracle, ORCL, and Workday, WDAY, see as core to their offerings. How will that pressure force them to respond? Will we see them accelerate their own tech investments, maybe even make rapid acquisitions in AI or finance tooling just to counter OneStream and protect their market share? That strategic chess match is what we'll be watching next.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thank you for joining us on Breaking News to Trading Moves. We'll be back soon with more analysis of the market's biggest stories.